Welcome to Indianomics. On Tuesday, the Reserve Bank will announce its monetary policy. I have a bunch of top-rung economists who will tell us what Governor Rajan may do, what he will do, and what he will hint how banks and markets might react to his hints and actions. I have with me Jahangir Aziz of JPMorgan, A Prasanna of ICICI Securities Primary Dealership, and Pranjul Bhandari of HSBC. In a bit, I will also be joined by Melvin Rego, the Managing Director and CEO of Bank of India. But first, let me present to all of you and to my guests the CNBC TV 18 poll on what markets expect Governor Rajan will do.
We've cut interest rates 3 times this year and we're still in accommodative mode.
It is probably this statement by the governor in Jackson Hole that is making the markets sure of a rate cut on Tuesday. An overwhelming 85% of economists and treasury heads polled by CNBC TV 18 say a 25 basis point rate cut in repo rates is imminent in the upcoming policy. Respondents say it is not just the low consumer inflation, but the fact that the Fed hike fear is away for now and global commodities remain subdued. None of the respondents expect any change in the CRR or cash reserve ratio. 70% respondents say SLR or statutory liquidity ratio will be left unchanged, while 20% believe there may be a 50 basis point reduction and the remaining expect a 25 basis cut. A good 55% respondents said this September cut is the last cut for this year, but 40% believe there will be another 25 basis cut after a clearer picture emerges on monsoons. 5% were more optimistic than the others, expecting a 75 basis cut, including the one on Tuesday. The expectation of the rate cut also hinges on the fact that most respondents actually expect RBI to lower its January 2016 inflation forecast from the current 6%. 45% expect it to be lower to around 5.5 to 5.7%. 10% expect an even lower forecast of under 5.4%, while 35% expect the forecast to remain unchanged. On GDP, 80% expect the forecast to remain unchanged at 7.6%, and the remainder expect it to be marked down to 7 to 7.5%. The tone of the governor's statement will be as keenly watched by the markets as the rate cut action itself. A majority of the respondents are expecting the governor to sound neutral and not signal further cuts. 30% expect a somewhat dovish stance and a signal for more rate cuts.
Well, thank you, Ritu, for that poll. And now, may I welcome our guests, Prasanna of ICICI Securities and Pranjul Bhandari of HSBC are with us. In a bit, we will be joined by more guests. Well, let me start with you, Prasanna. What is the combination you are expecting? Are you sure there's a rate cut? And will it be accompanied by a lowering of both the RBI's inflation and GDP forecasts?
Yeah, so our base case expectation is that RBI will cut the repo rate by 25 basis points. And as far as the forecasts are concerned, yeah, we do think that inflation forecast for January-March will be lowered. In fact, that will be the rationale for RBI to cut rates because they've guided markets using the 6% target they have for the Jan-March period. As far as GDP, yes, I think it's possible that it could also be lowered. The estimate could be lowered marginally.
Well, similar question to you, Pranjul. Are you expected to be accompanied by a lowering of GDP and inflation forecast? And I assume you're also expecting a cut?
Yes, Latha. So we are expecting a 25 basis rate cut like the market. But I think the more important thing here is the change in stance. I think in this policy meeting, Governor Rajan will move from an accommodative stance, which he's had so far, to a more balanced stance. In some sense, I think he's been preparing the market for it over the last month when he has made some, speeches on the benefits of medium-term low inflation. And I think he'll formalize it in a policy statement in this particular meeting. And in terms of forecasts, well, yes, we think they're going to nudge down the March 2016 CPI forecast to about 5.5%. But I actually also feel that they may extend out the inflation forecast to beyond just March 2016 to sort of give a sense of the challenges that they are facing for their medium-term targets of 5% in 2017 and 4% in 2018.
I was just coming to that. What would he do beyond September? But before I come to that, what I have from both of you is both of you expect a cut and both of you expect that at least the inflation forecast is going to be lowered closer to the 5.5 mark. Jahangir Aziz has also joined me. Jahangir, would that be the first, what would be the first expectation on September 29? You're going with a cut?
Yeah, it's a hawkish cut. He is going to go and say that, look, 6% is no longer the target. Even if we go below 6%, we really need to look 12, 18 months ahead, and that's a 4% target. And so what are the financial conditions that I require in order for me to meet the 4% target? So I think it's going to be a pretty hawkish cut as opposed to the dovish hold of the Fed.
Okay.
So.
All right. Well, Prasanna, let me put this to you. All of you agree that there is a cut. Do you also think that he will hint this is the last cut? You know, the phrase that gave the previous pause a dovish pause was that we will look for emerging opportunity for accommodation. You expect that to be absent?
Yeah, I expect that to be absent, but you should remember that in June also when RBI cut rates, I think those words were not present. So essentially only in August they reintroduced the words, and if I remember correctly, these words were there in April also. So it's some kind of a pattern which RBI seem to have been following. But having said that, I agree, yes, I think for the time being we should expect this to be the last cut. But I don't think immediately RBI will guide markets towards 4%. I think 5% will be the interim target for January 2017 and 4% for January 2018. So RBI would like to proceed on that disinflationary path. Okay,
now, you know, one of the things the RBI could be noticing, and at least some of the brokerages, notably JPMorgan, concentrates on is what you call the core. You know, monsoons and global factors are giving us an advantage in terms of tradables and food. But what is our own contribution to inflation? That is the services inflation. Education, health and medical services have fallen from what, 5.7 to 5.5 in the last number we have, August. Don't you think that there is a chance that services inflation, the core inflation, can fall to probably 5.25, that inherently more space can come, Prasanna? You know, things which we don't see now, but maybe what makes us so sure that services inflation will not fall to 5% by January?
So no, so that's not my point. So I'm not sitting here saying categorically inflation will not fall. But like you said, I think there's a lot of uncertainty around it, and I think it will take time. So I think what the RBI has been doing also, if you look at the pattern of interest rate cuts, is they've been waiting for inflation to move down, and then they followed it with cuts. They've not anticipated a move down in inflation in any of their cuts till now. I think that pattern will continue. So if inflation surprises us all positively, much more than the trajectory which they lay out perhaps in this policy, then I think sometime next year rate cuts are always possible. But I think that is the caveat which RBI will come out with, and therefore it will be completely data dependent.
What's your sense, Pranjul? There isn't space, there isn't a likelihood that the core inflation will fall. Do you think RBI follows that at all?
Yes, I think it does. But, you know, here I just want to highlight what I call the service inflation conundrum. You know, it's very interesting that WPI has been falling 5% year on year. You have a CPI which is, you know, around 3.7, positive 3.7. And, you know, the general thinking is that the difference is because services inflation, non-tradable, is generally very high in the country. But if you look at the GVA, the GDP data, services, services inflation number, that is actually running at minus 0.5% year on year. So on the GDP side, you're not really seeing any pressure on services. And then when you break down that into further components, you realize that even services can be broken down further into tradable and non-tradable services. And things like trade and transport are running at a negative clip, but something like personal services, consumer services is still running at a very positive clip, is still running at 5 to 6% year on year. And because the CPI really, you know, accounts much more of this personal services, I think the space for rate cuts from here is actually very narrow. It's, you know, it's a choice of RBI to choose CPI over either GVA or over WPI.
Okay. Well, I would still think that why are we ruling out the possibility that services inflation won't fall? Exactly the consumer services, medical, education. You know, the last note from Sajid indicated that that one has fallen to about 5.5%.
Yeah, sure.
If it falls to 5.25%, why should there not be space for more cuts?
Right. I mean, I'm not. I mean, as Prasanna said, I mean, obviously there's uncertainty surrounding that, and it can fall. But the question is, that, as Prasanna said, is data dependent. I don't think it's data dependent to that extent. In an inflation targeting framework, you don't care very much what happened in the past. You really care what is going to lie ahead of you. So even if services inflation falls to 5.25%, what are the economic conditions that will sustain it to fall, let's say, to 5 or hold it at 5? In that case, you have to come up with an argument that demand is significantly weaker than any of the indicators that are suggesting, or that demand will become weaker in the next 2, 3, 4 quarters than what we are seeing right now. So I am not saying that you can't get rate cuts. I'm not saying that you can't have inflation falling, but you can't have that and you can't have growth at 7% or 8%. You need to stare at growth at 5%. And that will bring down services inflation, all core inflation, and then you can say yes. With that
what you're saying is, at the moment we don't have that much data.
We don't have.
You can't expect the governor to say that.
There is nothing that suggests that India's growth is going to fall to 5%.
All right, fine. Prasanna, now the transmission issue. Do you think liquidity has enabled some bit of transmission? After all, post-July, we have had a slightly better, with a call rate going below the repo rate, practically, for the entire period. Do you think, the Reserve Bank will hint or will, in fact, keep liquidity lower to ensure transmission? Keep liquidity higher to ensure transmission?
Yeah, so I think to some extent, if you look at market-based measures or market-based interest rates, particularly at the short end, definitely they have benefited from liquidity being actually being surplus, and RBI has been intervening quite regularly to remove that surplus from the market. But I think it's essentially a product of RBI's own FX intervention in the previous quarters, which has led to this situation. And I think that situation won't be persisting into the current quarter or the next. For one, I think FX flows have slowed down, and therefore RBI's activity in the FX market has also slowed down. And seasonally anyway, I think currency demand will be picking up this quarter, into the next quarter, which means that anyway, I think the liquidity conditions will actually tighten and perhaps dip into mild deficit going into November, December. Okay.
Well, the other point which can perhaps push base rates down would be if the yields fell. Now, Jahangir, obviously the yield has been a little stubborn at that 7.7 mark. Do you think the RBI could perhaps open the floodgates more for FII money, FII infusion into debt? Will that be something you watch out for? Or do you think the Reserve Bank's hands are tied because that will strengthen the currency?
Look, I mean, that's an extremely interesting question, that on the short end of the curve, the RBI delivers 75 basis points of rate cut, and the same RBI, which is the debt manager of the government, is unable to move the long end of the curve. And that's a question that the government should be asking RBI, but it's a separate question. I really don't think that the RBI thinks about bringing down the long end of the curve by allowing more demand for government security. That would be the wrong reason to increase the limits. They won't do that. I don't think. There may be other reasons why you want to do that. You want to increase the diversity of the pool of investors who hold government securities, etc., etc., etc. But to raise it because, I want to bring down the long end of the curve is not something that the RBI would be willing to do at this point.
That's not their way of thinking.
I don't think so.
Okay, Pranjul, we'll have to wind up. So what would you be looking out for? You would, of course, be looking out for whether that phrase emerging opportunity is there in the text, but what would you be watching out for other than what we discussed?
Well, as I said earlier, I think I'll be watching out for a clear move from an accommodative stance to a balanced stance. Repo rate being brought down to 7%, which is the long-term average. It's the average across different business cycles. It sort of is a level at which the economy, the RBI thinks it's on balance. I think the RBI will want to be there, and by just being there, it actually signals that it's open to emerging space opening up. But as of now, it doesn't see that space, and therefore it plans to remain there for a prolonged period at this point. I think there's going to be very clear discussion on the next two medium-term targets, 5% and 4%, and the challenges and prospects of reaching those. I'm also hoping that the RBI speaks a little bit about the upcoming challenges on 7th Pay Commission, possibility of inflationary challenges from the GST, and so on. It'll be good to see what they think about these few challenges which might be there in the next 12 months or so.
Fair point. Prasanna, what would you watch out for?
So essentially, I think broadly along similar lines, but I think it will be important for RBI to stress that 5% is the interim target, and then 4% only kicks in from 2018 January. If they start guiding markets at using 4% as a target, I think markets could get spooked. Bond market is not prepared for that. Say within the next 12 months for RBI to target 4%, I think that would be important.
Okay. Jahangir, what would you watch out for from the statement?
I think beyond what Prasanna and what Pranjul said, I think what I was looking for is that, look, the governor has tried very, very hard to separate India's monetary policy decision from that of the Fed. Yes. I think he was going to keep on doing that. All I want to know is that how hard does he have to struggle in this statement to say that whatever the confusion that was caused by the Fed and what Janet Yellen's statement was of yesterday, to what extent that even that doesn't have an impact on his monetary policy view. So, what are the, when does that become a problem? Because we know that that is a binding constraint, even though the governor, both in the press conferences and in the statement, has tried very hard to separate India's monetary policy from that of the US Fed.
Okay, so he will have a point to make on whether he can move with cuts in spite of the Fed hike.
Exactly, absolutely.
He has got, of course, some space now with the Fed postponing or continuing with its pause. So we'll have to see what he says about the international events. We'll have to see what he says about what is the next inflation target. Will it be the 5% of January 2017, or does he go all the way to 4%? And what does he speak about fiscal deficit? That's the key takeaways from my guests. Jahangir, Prasanna, Pranjul, thank you very much. My point is, in a sense, we are making much of watching RBI. RBI cutting rates won't mean a thing to you and me. As depositors, we have to worry if banks will cut FD rates, and as borrowers, we will have to rejoice only if banks cut their lending rates, their base rates. Will they? After the break, Melvin Rego, the Managing Director of Bank of India, will answer these questions for us.